took all the profit. Red arrows drowning in the market's grave. Uncle Toro on the bull run, feel the thrive.
For the last 25 years, Japanese interest rates for borrowing the yen, which is their national currency, have been between 0.1% negative or just 0% flat. The negative interest rates have been active for the last 8 of those 25 years, and that was at least until March of 2024, when interest rates for the first time in a quarter of a century rose up to positive 0.1% and onward to a quarter of a percent further on in July 2024. Japan's banking system works a lot like the US does, through fractional reserve banking, which means when you deposit money, the bank keeps a small fraction on hand and lends out the rest to generate growth. This is how the world goes around. The whole reason they had to lower interest rates to such extreme numbers was to combat hoarding and force money back into the economy, because otherwise, paying a bank to hold your money doesn't make any goddamn sense. Suppose you might be curious as to why they did it at all. What was the point of all this interest rate collapsing and these crazy negative interest rate numbers? It's because decades of falling prices had led consumers and companies to delay their spending. It pretty much froze economic activity. Interest rates receded from a high of 6% in August of 1990 down to 0% in 1999, which is pretty crazy if you stop and think about it. But why does this matter for them and all the banks? Because just like COVID, when the financials of a nation are attacked through whatever channel, doesn't matter what it is, then the spending will stop. And the cyclical stimulation of a healthy economy begins to reverse. In order to create a new momentum and confidence in the larger economy, the government has had to step in to create incentives for people to spend their money again. The bank's going to cause the fee to borrow that money to be lessened, or in this case, nothing. So, in theory, more money borrowed equals more money spent equals economic boom. I mean, at least that's the theory. In reality, Japan got stuck in a liquidity trap where no one wanted to borrow for free due to the trauma that it had from its own recent economic downturn, forcing the Bank of Japan to resort to negative interest rates. The negative to non-existent interest rates created a unique opportunity for decades for those that were paying attention, eventually to be dubbed the yen carry trade. This is the kind of finance nerd shit that gets me HARDAF, boy. The yen carry trade, in a nutshell, is countries, institutions, banks, anyone that knew what to do and where to look, borrowing money in the form of yen from the Bank of Japan, converting it to US dollars, and investing the loan back into their own systems and their own markets. Everyone was at the party. This was not an isolated thing. The US, Mexico, Brazil, Australia, people over here in New Zealand, the UK, and all over the Eurozone. Everyone was involved. And why wouldn't they be? Seriously. It was essentially free money to fund entire economies and make literal free money for their own pockets and simultaneously stimulate Japan's economy. It's a win-win-win, if you will. But most good things in life are not meant to last. Ask me how I know. A common theme in my own life. I'm going to be doing a therapy session next week, so stay tuned for that. So let's break this down real simply for the layman. I borrow from the Bank of Japan in yen. I convert it over to my currency as American dollars. And I buy government-backed US Treasury bonds at 4%. Or I invest all that into the stock market for an average of, let's say, 10 to 11% yearly gain. Once those payouts from those yields are received on my end, the original loan capital is paid back to Japan, converted back into yen, and paid back to Japan. And I get to keep whatever interest was earned by my investments, which at the same time creates a flood of liquidity and capital for the bond or stock market to rise, compounding its effects, right? Everyone starts dogpiling in, the bonds, everything goes higher and higher and higher. Especially because a lot of these loans from the Bank of Japan were taken out with maximum leverage, 3 to 10x. And these hedge funds and institutions would have done a lot more if they didn't have risk management teams having a fucking heart attack, trying to justify some insane potential belly flop, drop, pop, and lock it, or whatever, you know what I mean? Japanese investors hold over $1.1 trillion in US Treasury debt. So the Japanese are doing this own thing to themselves too. They're borrowing from their own country and putting it into US bonds. So it ain't just, they're not victims here, okay? But meanwhile, Wall Street and global hedge funds still hold an estimated 200 to 400 billion in active yen carry trade debt that hasn't been paid back yet. So now they're paying that interest back on that. As long as the yields from those investments are greater than the conversion costs, we're good. And however, we start getting into a dangerous territory here. Because cheap yen borrowing was the primary engine for global leverage, higher Japanese rates forced investors to pay off their own yen debt, pulling cash out of foreign markets and creating sharp volatility in US stocks. For decades, near zero rates in Tokyo had forced Japanese pension funds, banks, life insurers to park their massive savings in higher yield US bonds. They just weren't getting anything out of their own government, so all this money from Japan came flooding into the US. This means that some of that capital that was from the yen will now be leaving US bond markets, causing bond prices to fall, thus reactively causing yields to increase, stalling further US economic growth in an already strained state. It starts to compound. This is why it's not good. Usually compounding is good, but this one is definitely a little bit scary. What this means in a nutshell for the future of the US and global markets is that a respectable amount of liquidity and bubbling tech valuation was inflated by free interest loans from Japan. But Big Mama Japahama is calling home from the crows to roost or to nest or whatever the fuck. You know what I mean? And then they want their payments back on that money. The money creates margin calls on highly leveraged institutional positions that cause the bubbling assets we currently have to begin losing some of that valuation and potentially trigger the next bear market in an already theoretically overbought market. So how do we capitalize on this? We become aware of it first. That's the point of this video and several others like it. As traders, we can play the north, south, east, west. It doesn't matter which direction that we can go. If we can anticipate and react appropriately, then we got to be ready to pounce. We can capitalize on any situation and scrape our little cream of the crop off the top, maybe with a little bit of sprinkles, you know what I mean? So we're watching the bond markets. We're looking for those higher interests so we can know when to short and when to go long. We're waiting for relief rallies and massive sell-offs in anticipation of a potential overall downturn. We are in the thick of it now, boys. Let's do what we do and we kill the market. BearForceOne out, baby.